Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, August 2nd, 5:22 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend, possibly some cracks forming, at least in the short term. A second cautionary day within 5 trading sessions. That's a change in character to me. As far as market leaders go, we're still on bullish slash uptrend, but we've got the yellow arrow out pointing toward neutral as 5 of the 8 in our RG8 have broken below the 21 EMA, and also some very ugly action by a lot of leading stocks today. As far as the major averages go, the 5 major averages, we had the first one break the 21-day exponential moving average, first time in a while, and it's a big one, the NASDAQ 100, which led for an extremely long period of time this year, finally breaking below the 21. It seems like it was just a few weeks ago, we were extremely extended from the 50-day moving average. I've said it before. 3 things that are a certainty in life are death, taxes, and reversion to the mean by the indexes, and that's what we're seeing. Whether or not it's a complete change in character remains to be seen. We take things a day at a time here. We take it a level at a time, and we judge the indexes, excuse me, and individual stocks on their own merits, but certainly not good action in 2 of the last 5 sessions, starting with the big negative reversal last Thursday, which coincided with a spike up in interest rates, and rates made higher highs today. Another piece of bad news for stocks. So 4 of the 5 still above the 21 EMA. In fact, the S&P is sitting right on the 21-day moving average. We'll see that when we take a look at the charts here in a moment. All 5 still above the medium-term 50-day moving average, long-term above the 200-day moving average. All 5 indexes above there also. So what just happened today? Second caution day, as I said, since last Thursday, yields making higher highs, NASDAQ below 21. All this stuff is different from what we've seen over the last 2 months, 2+ months. Here are the numbers on the day, and they're not pretty. RG8 down 2.3%. This is our 8 growth ETF. This synced with what we saw in individual stocks today. Biggest loser of everything we're quoting. S&P 500 gap down 0.7, closed down double that, down 1.38%. NASDAQ 100 down 2.2. Worst index of the day, as all 7 of the big 7 finished negative. After hours tomorrow, we've got Apple and Amazon earnings. Definitely we'll be paying some serious attention to what's going on there. Dow down 1%, mid caps down 1.1, Russell 2000 down 1.4, Global Diversified 60/40 stock and bond down 1.04%. In-house GROTECTION down 1.66%. We'll hit the tail of the tape in charts of interest, which will include a lot of earnings reactions and the portfolios of everything that we're holding in-house. But first, let's get to the indexes here, as we always do. Get rid of the stochastics and blow this up a little bit. You can see here quite clearly, I've got it noted with a little triangle there, the big negative reversal last Thursday. This made those 2 sessions after that and yesterday's consolidation day basically a sucker's rally, as we made lower lows today with distribution. So the S&P 500 closed, it's a rounding error, basically right on the 21-day moving average. It undercut it briefly, got back above it, then into the close, right into it. You can see on a 5-minute chart here, big gap down, and then 3 waves down. You can see it pretty clearly, 1, 2, 3, and then a little move higher. Actually, the way I counted it technically is this was 1, this was 2, this was 3. This was an attempt at a recovery, but you'll notice we didn't make it back above 45.28 and then a bounce into the close. So arguably 4 waves down before the bounce into the close, leaving us right on the 21-day moving average, right above 4,500. Let's go to this 30-minute chart because I pointed out the importance of 45.30 yesterday, and we broke that today. This rally could not get back above it. So now we've got a break, a retest, and a failure to reclaim. Actually, twice. Here we got to 45.28. Here we got to 45.26. This was a pretty key area. You can see it referenced back here on the gap down day. You can see it back here pulling back. You can see it here. It was the breakout level. So this 45.30 is a big level. We broke it. In order to get any semblance of bullishness back together, we need to reclaim it right away. Not to mention the fact that we need to hold today's lows as we're sitting right on the 21-day moving average. So that's our view on the S&P 500 for the short term. Let's go to the NASDAQ 100 now. And very clearly, you can see the break of the green line, the 21-day exponential moving average, down 2.2% on the day. Remember back here when we were double digits above the 50-day moving average? And then we made higher highs and we were still not as extended. And then we started to pull back. I've been noting how the relative strength line has been just keeping in sync with the S&P 500, so arguably correcting through time, but now today correcting through price as well as last Thursday. With the big negative reversal, actually made a higher high on Monday, but couldn't close above it. This harsh day down, breaking below. I mentioned, you can see on the 30-minute chart, I mentioned 375 as a key level. Yesterday, you can see how many times that was touched over the last 3 weeks. And then once we broke it, we struggled to get back above it and then ultimately closed below it. So this is the first level that needs to be reclaimed for any semblance of restoration of the uptrend in the short term for the NASDAQ 100. Very clearly, you see the close below there, slightly off the lows. The low of today still above this 372.85 breakout area, which was the high of the left side before we had this breakout on 712. So we haven't completely given up the breakout on 712 on the NASDAQ 100, referencing that same level on the S&P 500. We're still holding that also. That closing level on that day was 44.72. So that'll be the next support area down that we'll be taking a look at. Dow Jones Industrial Average, relative strength down, but relative strength. This is typical of what you see in pullback markets. The Dow will hold up better, and it certainly is holding up better. Still down 1% today, breaking the 80 EMA, but the furthest above the 21 EMA of the 3 big cap indexes. Let's move on to mid caps now. MDY bounced at the 21 EMA today, so we've got our line in the sand there. Still maintaining the breakout above this cup and handle 476, but very clearly failed now at this 500 level. That's the next level that if we want to get back on the bull train for mid caps, we need to clear 500. A couple closes above it would be nice, but certainly we want to hold today's lows also. IWM, small caps, couldn't break above this 199 level. They're still above their cup and handle breakout level at 189 and still above the 21 EMA, but a close again below the now rolled over 8-day exponential moving average. So ugly reversal down last Thursday, higher highs, 2 actually higher high closes, one of them on a pullback, but today not so good. So those are the major indexes. Let's go to the VIX, and you're going to see a big move up on the VIX here, up 15.5% above the 21, above the 50-day moving average, and above this 15 level that kind of symbolized the healthy bull market, except for this one shakeout that we had here on 7.6, but back above those levels. That's another thing that is certainly going to make us cautious, but we'll be watching for a reversal back below 15, coinciding with any rally in the market to see if the fear level still stays there, but definitely an expansion in the range on the VIX today and a higher high since the pop last Thursday that coincided with the market sell-off in the VIX. Let's go to the dollar. This is not helping stocks either. Continual, basically straight up move for the dollar over the last 2.5 weeks, making higher highs, going from a false breakdown, a failed breakdown, to testing the highs of the range from May and June. That's bad for precious metals, and it's not good for stocks either, particularly not good for international stocks that make money, a lot of money from overseas. Let's go right to the precious metals to see how they reacted today. Silver down 2.4%. Gold not as bad, but this is being. I'm told from Twitter that this is a safe haven with the Fitch credit downgrade. We'll see. It is making new recent lows, so that breakout is cementing the fact that we've got a failed breakout there. Even worse on gold stocks, GDX now below the 200-day moving average. Certainly not good stuff there. Let's quickly look at Bitcoin. Down 0.5%. Let's bring in, that's the Bitcoin futures. Let's bring in the Bitcoin chart here and the standard, the Keltner channels or ATR from the 21. Bitcoin is below the 21, so below our short-term signal, bouncing at the -1 ATR from the 21 at this point, trading at 29,240. Back to the market Smith charts, and let's go to bonds. BND, broad bond index, gap down, but did close at the highs. So somewhat of a support level on bond prices going back to this 7.6 big gap down in prices, which coincided with a big move up in yields. And that was also that big spike up in the VIX that we referenced also. So with two gaps down here, we'll see if we get a little bit of a reprieve tomorrow. TLT, the long bond, down again, lower lows. So you know that's going to be higher highs on the yield. And there it is, 4.0 back here now, all the way up to 4.2%. This is not good for growth stocks. I've explained that several times. Let's go to the 10-year TNX. 10-year higher closing highs also, higher intraday highs also, not higher closing highs relative to this big spike up on 3.2, where we have cleared that on the long bond. And really that means on the long bond that it means that the inversion, the curve is getting less inverted as the higher rates are, or long-term rates are accelerating upwards at a quicker pace than shorter term rates are. Does that cover everything? That does cover all the inter-asset correlation. Let's get to the tail of the tape now, and then we'll get to some charts. So still showing an uptrend. The fear and greed index dropped off of extreme greed back down into greed. That's from a sentiment standpoint, that's a little bit of an improvement, but you can see the big VIX spike up there. Bear case is if we get back below the 21 EMA on the S&P and the Qs. The Qs, it certainly did happen. The news, this gap down at the open, all due to the Fitch downgrade is what we're hearing, but the rise in interest rates also certainly having to do with it, and whether or not that rise in interest rates is tied to the downgrade, that's not for me to decide. Note day count, still the 42nd day since the breakout higher on June 2nd, but certainly down 1 day is the day count. First closed below the 80 EMA, 46 day above the 21 EMA, but just barely above it. In fact, we had a UNR today, as I mentioned. Our expectations flip to neutral now with this action at the 21. We need to hold that tomorrow on the S&P. Some notes that it's not a complete exodus from the market is that we'll see down here on the sectors, XLP, U, and V were either flat or up on the day. It was mostly tech and growth that got hit, and leaders and GDX. TAN down, XLC and K down very hard. Let's add XLY to that also. Chucky, the big the big three tech sectors, semiconductors, and all the software stocks. Cyber looked great yesterday. Cloud stocks, cyber, and broad software, enterprise software down hard today. In-house on the portfolio, we made some buys and some hedges. Well, we added back some T-bills as the yield is still there over 5%. We bought SPXL on the undercut and reclaim earlier in the day of the 21-day moving average. Now we're sitting right on there, so a short leash with that. Hedging belongs with QID on the NASDAQ 100 break below the 21-day moving average. So that's subtracting some beta, and that'll increase as needed. And a small buy on SYM. This was the data center component stock that was up 50%, pulled 2 days ago, pulled back, still in the upper part of the wick. We added to that. We'll look at that chart also. Then we'll look at some earnings winners and losers, as well as go through the portfolio. But the bottom line on the day, change in character, the Fitch US credit downgrade, and yields higher are the reason for the change in character, not to mention that leaders were hit hard and the NASDAQ 100 breaks below the 21-day exponential moving average. Second big caution day within 5 sessions tells me what I need to know. We've got our stops in place. We're a little more than 2.5% off of client highs for accounts. And like I said, got our stops in place. We take the gains when the market's going to give them, but we fight like hell to preserve them when the market wants to take them back. So I talked about this beta level, this adjusted beta level, that I want to keep it above a 1.5 or above when we're above the 21. We're right now on the 21. If we break below the 21, the minimum beta drops from 1.5 down to 1.0, and that'll pretty much coincide with us hedging or stops taking out our positions. So let's get to some charts here. First, let's go through GROTECTION, and we did buy SYM today. This was the massive move up, 50.6% on 400% average volume, to an inside day after a normal pullback after this big move up. So we added, this is a volatile stock, just took a 1% position. We liked how it held this 53.83 pivot on the pullback. Very quick stop out below today and yesterday's lows if it doesn't hold. We're also still holding this Mara that we added yesterday. This was up early in the day, but had the negative reversal. Still holding above the 21-day EMA. Those are our smallest holdings. Uber actually put in a positive day today. So this yesterday's low. This was green early in the day, undercut the 21, reclaimed it, closed back above it. Actually closing up is a pretty big accomplishment for a leader in a market like today. So for now, the 21 EMA is putting in a support area for Uber. Let's see how close that is to the 10-week. Still quite a bit above it, 6.5% above the 10-week. And 9% above the 50-day. So we won't let it get down that far. This is the last piece of it that we have as we cash profits on the way up. Booked some yesterday with it breaking the 8 EMA. Today's low is the stop for the rest of it. SMCI continues to act great. Break of today's low will get us out of this though, and we'll book our gains for that. Extremely volatile stock. If all growth stocks are going to be selling off, we don't want to give up those big gains. Tesla, lows of today, critical, coincided with the 50-day moving average and also the 10-week now. Actually, I believe it's a couple bucks below the 10-week. Yeah, 10-week is at 257. This is at 254. So we're watching that closely. That's for the recent buy to get stopped out there, but a significant break of the 10-week by the end of the week will get us out of the big gains that we made back from the 190 entry levels. What's next? NVIDIA, not a good day for NVIDIA today. Closed below the 21-day exponential moving average. We've got stops in place for below today's low. It did undercut and hold that key 440 level. You can see it's testing it somewhat after hours. That's a very big level. We gave it some room today to see if it could reclaim the 440 and hold it, and it did on multiple pullbacks late in the afternoon. But like I said, with the market being the way it is. We're not going to give all of our profits back. The big gains that we have from earlier buys will buys before the gap up on earnings. We're using the 10-week or 50-day moving average for that. NRGU, uh, profitable on both buys there. The last buy will give it up below today's low. And SSO, that is the component that will get the most room. I don't want to show SSO. We use the underlying, which is the S&P 500. That'll be given the most room down to the 50-day moving average, and then hedging if we go below that. So those are that's the portfolio. Now let's take a look at some individual charts. Big winner today, VRT up 29%. This is again um, data center equipment, AI. I mean, it's that simple. Parts being ordered left and right to support AI in these data centers, up 582% on 29% average volume. That's massive. So we'll be watching that one going forward. Another one that just won't quit, ears, lips, face. That's ELF, up 14%, close at the bottom of the range, but this is just an absolute model book stock. EXTR. Now, well, yesterday we saw ANET, again, data center network, gapping up, gave back some of it today, right to the pivot. And then today, EXTR reported, another networking group, up 8.5%, breaking out. Good stuff there, same group. So paying attention to that. Caterpillar, stubborn giving back, made initially a higher high, just down a little bit. That looks fantastic. AMD, this was sad, gapped up and reversed immediately and down near the bottom of its range now, breaking the 21 and the 50-day, ended up down 7%. Disappointing reaction to their earnings report. One that we sold last week, DT, terrible reaction to its earnings report, down 13%. One that we had been looking at in the 2121, not there anymore. Generac down 24%. Clearly breaking the 21-day and the 50-day moving average, and VICR in the 21 over 21 because of this 57% move up on 900% average volume. It broke and then closed right at the low of the gap up day. We're keeping an eye on this if the market can get its stuff together. But really, the bottom line now is we're not looking to, unless we see a positive reaction tomorrow by leading stocks and the indexes and a reclaim of the QQQs of the 21-day moving average, we really won't be looking to add much more. Much more exposure to the market. This is just these two ugly days in 5 and making a lower low. I remarked how this was kind of an inflection point when we made that we wanted to hold the lows. We held it for 3 days, but really it was just a consolidation before the bears took back over today. Whether the Fitch credit downgrade means something or means nothing. I commented last night, Fitch has no credibility at all. None of the ratings agencies do after the shenanigans that they pulled with the financial crisis. But if you read the report, you can't really argue with anything that they're saying about the fiscal policy of the US government. So that is what it is also. We factor all of these things in. We take a look at how they're reacting, how the market is reacting to them. It's not necessarily the news, it's the reaction to the news. The reaction twice in the last 5 days has been decidedly negative. So with that, we will look to put our defense on the field if things continue to deteriorate. And that's going to wrap it. As always, like to hear from you. Email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Of course, it's not how much you make in the market, it's how much of that you can keep. I talked about our drawdowns earlier, stops in place, looking to see what the next card or cards are going to be that the market's going to deal, and see how that fits in with the hand that we currently have. And with that, I'm going to wrap up today's video for Wednesday, August 8th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.